Trust we are doing great. Please confirm you can hear me clearly.
I hear you, sir. Good evening, sir.
All right. Thank you, sir. We don't need to waste time on this. We are rounding up on budget tonight. Our last class, we treated production budgets. We looked at cash budgets. And we looked at the profit and loss budget. Under budget preparation, you may be required to prepare production budgets. That is your functional budget, your production budget, raw material purchase budget. You can also be asked to prepare financial budget. Your financial budget will cover the cash budget, the profit and loss budget, and the budgeted balance sheet. Equally, you can be asked to prepare flexible budgets or flex budget. If you look at last diet, examiner tested flexible budgets. Whether budget will be tested this year or not, nobody can say with certainty. But I will encourage you to try and understand cash budget preparation. Whether the examiner will test question on budgets or not, nobody can say with certainty. But it's been a while that cash budget was tested. So if you go back to that, our last lecture, look at the concept of cash budget. Your cash inflows and your cash outflows. All right. Tonight specifically, our attention will be on flexible budgets. A budget that is designed to accommodate changes in circumstances. If you recall, we explained fixed budgets, flexible budgets, and flex budgets. Your fixed budget is the original budget of the company, the original plan of the company. That budget that is not designed to change. Your fixed budget is prepared prior to the budget year. We equally discuss flexible budgets, a budget that is also prepared prior to the budget year. But this budget can accommodate changes in circumstances. Then we have the flex budget. The flex budget is prepared at the end of the financial year. After you have gotten the actual results. And we explained that flex budget is prepared using your actual results with the budgeted cost and the budgeted revenue. And we said that flex budget is basically variance analysis. That is the last topic we are going to treat next week. Please refer to illustration 4 in your study pack, page 101, question number 4. Page 101, question 4. Let us look at the question so as to explain how to prepare flexible budgets. Please refer to page 101 of your study pack. Are we good to go? I'm assuming that you have opened the study pack. All right. TJ Limited is an industry sector which is just recovering from the recent recession. The director of the company hopes next year to be operating at 85% of capacity. Although currently the company is operating at 65% capacity, representing output of 10,000 units of the single product which is produced and sold. One 100 direct workers are employed on production for 200,000 hours in the current year. The flex budget for the current year is as follows. You have at 55% level, at 65% level, and at 75% level. We have the direct material cost. We have the direct wages. We have the production overhead cost. We have the selling and distribution cost. And we have the admin overhead cost. If you check your material, that admin overhead is supposed to be 120,000, 120,000, 120,000. If you check under 55%, there was an error there. That 2, you are going to remove 1 2. It is not 1 million. It is just 120,000. So please adjust this in your material. Also, if you look at your material, you have 55%, 60%. That 60% should have been 65%. Now look at this. The profits in any year. Please note, this is 16 2/3. What you have here is it's supposed to be something like this. It's supposed to be 16 no number 2/3. (16) 2/3% of sales. That is the profit margin. Not 162. The following percentage increase in cost is expected for next year. Direct material cost will increase by 6% next year. Direct wages will increase by 3%. Variable production overhead will increase by 7%. Variable selling and distribution overhead will increase by 7%. Fixed production overhead by 10%. Fixed selling and distribution overhead 7.5%. Admin overhead 10%. Required. 1. Prepare for next year a flexible budget statement on the assumption that the company operates at 85% of capacity. Your statement should show budgeted contribution and profit. We are to prepare flexible budgets at 85% level of capacity. Currently, the company is operating at 65% capacity level. Your page number 1 is for your budget statement. Now let's go to the workings. If you are faced with question of this nature, you are giving capacity level in percentage. The first thing you should try to do, convert the percentage to units. Your working number 1 is the capacity levels in units. Now look at the working place. Examiners say at 65% level of capacity, output level, output is 10,000 units. And I want to get for 55% capacity level. This is given in the question. If you want to work for 55%, this becomes 55 over 65 multiplied by 10,000 units. Because at 65%, output is 10,000 units. If you want to guess for 55%, please, who is completing this class? Andrew, please, can you mute? Can you mute your speaker? Please work this out. That will give you output level at 75, at 55. For 75, 75 over 65 multiplied by 10,000 units. For 85, 85 over 65 multiplied by 10,000 units. That is how to get the output level for the different units, different percentage capacity you are giving. Yes, what do we have here? Please, can we check our calculator and give figures? Please, can we compute and supply figure? So as to help this class.
$8,462.
I can only try. All right. We have gotten you have gotten the output level in units. Now you're working number 2. You are going to test for cost behavior. What is cost behavior? How cost behave in relation to the volume of production. A cost can be variable cost, or fixed cost, or mixed cost. You are going to test for all the costs you are giving. If you go back to the question, we are giving like 5 types of cost. Direct material cost. You are going to text it. Is direct material cost a variable cost, or a fixed cost, or a mixed cost? you are going to text. When you are done with material cost, you go to direct wages. Is direct wages a variable cost or a fixed cost or a mixed cost? When you are done, you go to production overhead. You are going to text all the costs you are giving. I will start with material cost. 1. Direct material. Our capacity levels. We have 55%. We have 65%. And we are giving 75%. The output at 55, the output is 8,462. At 65, output is 10,000 units. Output here is 11,538. Then pick your material cost. That is in Naira. The first one, assuming you open this question, let's just supply this figure for me. 846,200, 1 million, total material cost here, 846,200,000. Total material cost here in Naira, 1 million Naira. Total material cost here, 1,153,800. Am I correct?
Yes, sir.
Are these figures correct?
They are correct, sir.
All right, thank you. Now, for you to text, you are going to get cost per unit now. Material cost per unit. Total material cost divided by total output, 846,200 divided by 8,462. What is material cost per unit here?
100.
100. Also check here. 1 million divided by 10,000. What is material cost per unit? Also check here. 1 million, 153,800 divided by number of output. What is material cost per unit? $100. Please note, if cost per unit is constant at all level of activity, that is an indication that that cost is a variable cost. Please note, if cost per unit is constant, cost per unit is constant at all level of activity. That is a confirmation that that cost is a variable cost. In other words, direct material cost is a variable cost. Direct material cost, direct material cost is a variable cost. We have texted. When you are now done, calculate material cost for next year, where we are going to work at 85% level. At 85% capacity. Total direct material cost is equal to, at 85, we are going to produce 13,077 units. Look at it here. My expectation is to have a participatory class. Look at it, at 85, we are going to produce 13,077 units. And material cost per unit is 100 naira. Multiply by. Examiners say next year. Look at it. The following percentage increase in cost is expected next year. Direct material cost will increase by 6%. That means next year, material cost will increase by 6%. 6% increase in cost. That will take us to 1.06. That will give you total direct material cost at 85% capacity. Please, can we work this out? And if there's any question, please speak up. Can we work this out?
The answer is 1,386,162.
1,386,162. That is the direct material cost at 85% activity level. You have included the expected increase in material cost. You are done with material. You now come to direct wages. Direct wages. In your exam, your knowledge of cost estimation. That was the first topic I treated in this class. You are going to require it. For those that started the class with me, I said this topic we are treating first. We can enter any topic in PM. May God guide us aright. the capacity level, 55%, 65%, 75%. Output in units, 8,462. $10,000 units, 11,534. 538. Now, direct wages cost in Naira now. Back to the question. Direct wages, 1,480,850, 1,750,000. $1,480,850, 1,750,000, 2,019,150. I hope I'm correct.
Yes, sir.
That is the highest I can do. That's why if you give me figure, it saves time of strolling up and down. But if you don't respond, what can I do? We'll try our best. It's supposed to be direct wages per unit. Total wages divided by number of units produced. Please divide and give us figure.
175.
Total wages divided by number of units produced.
175 again.
Try this again. Total wages divided by number of units produced. You observe that direct wages per unit is constant.
Yes.
Please note, once your cost per unit is constant, 1 per 1 per 1 per 1, that's a confirmation that that cost is a variable cost. Please, you can write it down somewhere. You cannot escape cost estimation. That knowledge is a must for accountants. For accountants, the knowledge of cost estimation is a must, because accountants, what we do is that we estimate figures for management to plan. We estimate figures to guide decision making. So just come here now. Direct wages is a variable cost. So now do add, that is direct wages is a variable cost. Now, at 85% capacity, total direct wages is equal to, at 85%, we are going to produce 13,077 units. Direct wages per unit, 175. Now go and check. Any increase in direct wages? Look at this. Direct wages will increase by 3%. I don't need this. Thank you. Direct wages will increase by 3%. That means 100 plus 3, 103%, in ratio 1.03. What is the total direct wages?
I will save these things. My head pain, what I'll do.
2,357,129.25.
Sorry, I didn't get that. 1 million.
2,357,129.25.
129. Please ignore points.
You mean me?
Okay.
Yes. Ask a question, I know the answer. Don't see me when we say I follow
Please,
them.
madam, please, can you mute and have your discussion in your private house?
I didn't know. I was thinking of shut down.
Please, can you do others favor? Thank you, please. If you want, of course, you can have your private discussion. But when it's conflicting the class, then it becomes a challenge. All right. We are done with direct material texting, direct wages. We now move to production overhead.
Sorry, sir. Good evening, sir. Sorry, sir. Hello, sir. Hello, sir.
Yeah, hello.
Sir, please, where do we get this 1.03? Please, can you help me out? I just joined the class not too long.
You just joined the class now. We have the question with you. Do you have the question with you?
No, sir. I don't even know the page you are considering.
Page 101.
Okay, sir.
Now look at where we get this from. Direct wages. Look at the percentage increase in cost expected for next year. Direct wages, 3%. So direct wages cost will increase by 3% next year. So we have to incorporate the increase in wages. Is that better, please?
Yes, sir. Thank you.
Some are not even aware that their speaker is disturbing us.
There should be a way at which you can move to them from your end there.
And which there is now. As he automatically mute, the person will open his speaker. He's not even aware his speaker is not even aware that the speaker is on. So even if you mute and your own system is taking your speaker off, production overhead. Production overhead cost. Let me come here first. The third cost to be texted. Production overhead cost. You have the capacity. %55, 65%, 75%. The outputs in unit 8,462, 10,000, 11,538. Now go and pick the production overhead cost as given to you.
The first one is
If you have the material,
59170.
okay, let me go back there. Thank you. That saves us the time. 5 what?
5,96170.
Thank you. Next.
650,000.
Next.
703,830.
Okay, 30. $830. Now, get overhead cost per unit. Overhead cost per unit. Total overhead divided by number of units produced. 70.1 what?
$70.45.
45. Now check the second one. 650,000 divided by 10,000. This should be 65 naira. The last one, total overhead divided by number of units produced. It should be 61. I hope I'm correct.
61.
Now, if you observe this now, at 55% level, overhead cost per unit is 70 naira 0.45. When we increase to 65% level, overhead cost per unit falls. Is that not? When we increase to 75%, overhead cost per unit further falls. Please note, look at the notes here. Let me write it. Note, if production volume increases and cost per unit falls. Please note, cost per unit. Please note, there is a difference between total cost and cost per unit. Cost per unit falls. The cost is a miss cost. That cost in question is a miss what? Miss cost. Production overhead is a miss cost. That is production overhead cost is a miss cost. It contains elements of variable and fixed cost and fixed cost. So we have to separate the cost. That production overhead cost contains element of variable cost and fixed cost. We are going to separate it into variable and fixed. Variable production overhead and fixed production overhead. To separate it, you are going to use high and low method. To separate the cost, we shall use high and low method. The highest level, the lowest level. Output, production overhead. At the highest level, our output is 11,538. The production overhead is 703,830. Our low level, the production is 8,462. Overhead cost is 596,160. Abi? 170. You can see now that knowledge that was treated on the first day, we are using it for budget now. You now look for the differences. Differences between 11,538 minus 8,462. What do you have here?
3076.
107,660.
107,660. Thank you. This is the difference. You now calculate your variable
3076.
overhead rates per unit is equal to differences in cost divided by differences in units. 107,660 divided by 3076. What do we have here?
35 naira.
That is 35 naira per unit. The variable overhead rate per unit is 35 naira. You now determine your total variable overhead. You can do this either at the highest level or at low level. At high level, our total variable production overhead is equal to, at high level, we produce 11,538. Variable overhead per unit, 35. Multiply these two. That will give you total variable overhead.
403,830.
403,830. Thank you. Now look at what we are saying. At high level, out of this 703,830, 403,830 is total variable. What is total fees?
300,000.
No, we say, thank you. This cost, this production overhead cost, includes variable and fixed. You have gotten total variable. To get your total fixed, look at it. Total fixed production overhead is equal to 703,830 minus 403,830. That will give us 300,000. We have been able to separate the cost into variable and fixed overhead. When you are done, the next thing to do is to try and calculate the overhead cost at 85% production capacity level. Thank God. This night, we are not facing problem of what's it called? Network. I'm trying to extend the, so we are going to need, I have to extend this. Otherwise, there'll be, let me try and create more again. The more the better for us. Let me put it above. But if you don't have this margin, make the work loose somehow, not so. I'm hoping that this will be enough. Okay. I still have 2.
Hello, sir.
Yes, please. Please go
Yes,
ahead.
you need to correct that figure you wrote there, sir. It should be 403, 830, not 800.
Okay, yeah, you are correct. This should have been 830. $403,830. Now, you have been able to separate your production overhead cost into variable and fixed. You now want to look at your flexible budget for next year is at 85% capacity. At 85% capacity, what is total variable production overhead cost? Total variable production overhead cost is equal to, at 85, we are going to produce 13,077. Variable overhead per unit, 35 naira. Now go and check any increase in variable production overhead. Please check the question.
7% increase.
Thank you. Variable production overhead will increase by 7%. Also check any increase in fees production overhead. Fees production overhead will increase by 10%. Can we see it, please? Yes. So variable production overhead will increase by 10%. Can come here. Increase by 10%.
Variable
That would
7.
be, oh, thank you, 7%. 1.07. That will give you total variable production overhead.
489,7334.
489.
734.
734. That's correct. Then if you check your fixed total fixed production overhead, our fixed production overhead amount is 300,000. But this amount will increase by 10% next year, multiplied by 1.1. This will give me 330,000. The next cost now. You can pick this cost up to save time. The cost here is 1,386,162. I can go and put it there, 1,386,000. You can come here and be loading this. The cost here is 1,386,162. Second one is 2,357,129. $2,357,129. Here I have 489,734 under fees cost. I have fees cost, fees production cost, 330. All right. Next, we are here now. Selling and distribution overhead. We need to text it. Is it a variable cost or a fixed cost or a means cost? We come here for selling and distribution overhead. You have the capacity in percentage 55, in units 8,462, capacity in percentage 65, in units 10,000, 75% in units 11,538. Now please go and pick your selling and distribution. 192. This can you supply?
192,310.
Here we have 200,000 naira. Next.
207,690. 207,690.
Thank you. Now please take it to per unit. Selling and distribution per unit. Total sale divided by number of units sold.
$23 per unit.
You rounded up, Abi.
Yes, sir.
Give me 22.2 decimal places.
I can come, sir. That is 22.73.
Thank you. Here is 20 naira. What do you have here? 18.1.
Come, sir. 18. Round
All right.
figure.
Look at the trend. What happened to selling cost per unit? What happened to selling cost per unit?
Decreasing
Is
at the
decreasing.
output level.
As the volume of sales increases, the selling and distribution cost per unit falls. What kind of cost is this?
Missed cost.
Cost.
This is a missed cost. Just put a note. Tell the examiner that selling and distribution overhead is a missed cost. Once you put this note, examiner understand. Therefore, you need to separate it using high and low method. High and low. Output at highest level. Our highest level given to us is 75%. Selling and distribution cost. At high level, we produced and sold 11,538. Our selling cost is 207, abi?
$207,690.
690. And when the class is silent, I'll have to go and check it. Our low level is 8,462. The cost here is 192,310. The difference here, 3076. The difference here, what do you have? 15,380. Therefore, variable selling and distribution cost per unit is equal to 15,380 divided by 3076. How much, please?
5 naira.
5 naira per unit. Therefore, you now need to get your total variable selling and distribution. At high level, total variable selling and distribution is equal to, at I, we produce 11,538. Cost per unit, 5 naira. Please, what is total here?
57,690.
Sorry, I didn't get that.
57,690.
57,690. Thank you. Out of 207,690, total variable is 57,690. What is total fees? total fixed
150.
selling and distribution is equal to 207,690 minus 57,690. That will obviously give us 150,000. We got to create more space. Please, never can tell. Examiner may give you this question in exam. Out of God's mercies, almost all diets between 2 to 3 questions we solve in class is texted in the exam. So we encourage you to try and study your book. You now go and look at 85% capacity. What is total variable selling and distribution? Total variable selling and distribution cost is equal to, at 85%, we are going to produce and sell 13,077 units. Variable selling is 5 naira. Please look at the question. Any increase in variable selling and distribution overhead?
7% increase.
7%. 1.07. That will give you your total variable and selling. Yes, final answer.
69,961.95.
961.95. Why do you like points? Just round up and move.
Okay, sir.
Then your total fixed selling. Total fixed selling and distribution. This amount is fixed. It's not based on production volume. Amount is 150,000. Now go and check. Would there be any increase in fixed selling and distribution overhead?
7.5 increase.
7.5%. That will be 1.075. Get your value for next year. What do you have here?
161,250.
Two what?
161,250.
Oh, 161,
Yes, sir.
250.
250.
Yeah, that's correct. You can go back to your first page. Variable selling and distribution. 69,962. Under fixed sell and distribution. 161,250. Then go and look at the admin cost. Admin overhead. 120, 120, 120. At 55% level, admin overhead cost is 120. At 65% capacity level, admin overhead cost is 120. At 75%, admin overhead cost is 120. What type of cost is this?
Variable.
Eh?
Variable. The fixed cost.
Which cost?
Thank you. This is a fixed cost. You can see that that cost is not changing. We define fixed cost. These are costs that remain fixed in total, regardless of the level of activity. Whether you produce at 55 or at 65% or at 75%, your admin overhead cost is the same. In total, please, not in units. I keep on trying to repeat this. There is difference between cost per unit and total cost. For your fixed cost, it's looking at total fixed. The cost is fixed at all levels. Admin cost is a fixed cost. Now check for next. Would there be any increase in admin cost? Any percentage increase? Admin overhead will increase by 10%. Please increase 120,000 by 10%. What do we have?
$132,000.
Thank you. Let us show the working here. Admin overhead is equal to 120 multiplied by 1.1. 132,000. You are done with your cost, your test for cost behavior. Admin is 132. Please sum your total fees cost. 330 plus 161,200 plus 132,000. What is the total fees cost?
$623,250.
6 what?
623,250.
Thank you. It's a cost. We put it in brackets. We also need to sum our total variable cost. Direct material cost plus direct wages plus variable overhead, production, variable selling. Please sum up. 4 million watts. It should be here now.
4,304,987.
Please hold on, Jared. Let me write it down here. 4 million. Yes, 3 what?
304.
304.
Yes, sir.
Are you sure 4 too? Okay. 9,
87.
8,
Maybe I should confirm.
7. Okay, this is where it's coming from. This place should be 7. Because we solved it yesterday in the classroom. You are telling them to confirm. Okay, look at it, 7 or 9. So if you give me figure, at least I can still remember some figure we got. This should be 2. You can reconfirm. Here should be 7. We have gotten our total variable cost. We have gotten our total fixed cost. Examiners say we should prepare flexible budget. A flexible budget that will show both contribution and profits. That means I need my sales value. Is that not, please? The sales value minus total variable cost will give me contribution. Contribution minus total fixed cost will give me the in 30 minutes I should be done with this question. All right, let's continue. Please confirm you can see my screen. Internet is unstable.
Yes, sir, we can see your screen, sir.
All right. Examiner says profit in any year is budgeted to be 16.2/3% of sales. What the examiner has given you is what we call the profit margin. Profit margin will be on sales revenue, but we don't have the sales revenue. The only thing we have is total cost. Your variable cost plus your fixed cost will give you total production cost. In this case, you need to convert the profit margin to markup. The margin you are giving, 16 O number, 2/3% of sales. We now need to convert it to markup. Markup is on cost. To convert to markup, you can simply do like this. Look at it in working one here. There's a space created. Yeah, there's a space here. Please look up. Conversion of margin to markup. Markup is equal to margin. So number 2/3. This one now becomes 100. 100 minus 16 O number 2/3. Please apply your. You are going to get 0.2. That is 20%. Your 20%. 20% of your cost represents your profits. Please apply your calculator. You are going to get exactly 0.2. If you don't know how to go to 16 2/3, what you can do is, first of all, do 2 divided by 3. That will give you 0.66666666, then plus 16. That will give you 16.666. Write down flex. Now go to your 16.66666667. That will give you 87.333333. Now divide it to 16.666666 divided by 83.33333. You are going to get exactly 0.2 without rounding up. Once you have got markup, then we can calculate profits. If you come here now, our total cost, total production cost at 85% level is book cost 4,302,987 plus your total fees cost 623,250. Please sum up these two. $4,032,987 plus 623,250. That will give me 4,962. I have here $4,962,626. $926 237. That's the total production cost at 85% capacity. The profit is 20%. 4,926,237. Please compute 20%. 85,985,247. That is the profit to be achieved at 85% capacity level. Once you get your profits, you have your total fees cost. If you want to get contribution is profit plus total fees cost. Your contribution, your profit plus total fees cost. $1,608,497. Just do a work back. 1,608,497. To get your sales value, your sales value is contribution plus total variable cost. Our sales value 4,032,9. Ours your 911,484. You are done with this question. 5,911,484. You are done requirements A. You have been able to produce a flexible budget for next year. The plan is to produce and sell Our plan is to produce and say how many 13,077 units. And that must give us a revenue of 5,911,484. We are done with requirements 1. Like I said, let us carefully study the B part of the question. Or Roman figure 2. Examiner says, briefly discuss 3 problems which may arise from the change in capacity level. You are moving from 65% capacity to 85% capacity. What are the likely problems that will arise? Hello?
I can hear you, sir.
I said, imagine you find yourself as the plant accountant, a production accountant, and your company is trying to increase production capacity from 65% level to 85% levels. What are the likely problems that will happen? And I want to assume that it does not, it is not, I want to assume that yes, we can talk about this. But look at the likely problems. 1, there's likely to be a requirement for additional cash for working capital. Working capital requirements will increase. Our capacity level has increased. For example, the stock level will increase. Debtors level will likely increase. That means the company will require additional to fund debtor level. If you increase your production level, that means you need to buy more raw materials. To buy more raw materials, you require cash. If the cash is not available, that may be a problem. Number 2, it will be probable, it will be necessary to recruit more direct labor. If you increase your production capacity, you are likely to need more employees. You are likely to recruit more employees. The activities involve advertising, interviewing, and training. To recruit more employees, you are going to place advertisement. You are going to conduct interview. You are going to train your staff. that may lead to increase in your cost. Number 3, it may be necessary to reduce the selling price so as to sell the increased volume. That is, if you increase your capacity, your output level will increase. It may be necessary to reduce our selling price in order to sell the increase in volume. This could have adverse effects on profits. These are the likely problems. There could be other problems. We might need more storage. But examiners say, give me 3. The last aspect of this question. Who are the members of budget committees? And these are questions that could be texted in your exam. Members of budget committees will include a representative from each department of the organization. The committee is usually headed by the chief accountant. The representative from each of the following functions: the production, sales and marketing, personnel department, purchasing and distribution. We also be in the budget committee. Now, what is the purpose of budget committee? You can look at these 5. Why do companies establish budget committee? What are the objectives? 1, budget committee is for the coordination of the budget preparation. The committee serves as a coordinating unit of the preparation of budgets. This includes drawing up timetables and distributing the budget manual. Number 2, allocation of responsibilities for the preparation of budgets. The budget committee will assign responsibility to individuals. Number 3, the budget committee assists in the preparation of budgets by providing information as required. Number 4, control of the budgetary process, including, that is, the budget committee exercise control of the budget process, including highlighting and investigating the most significant variances Then lastly, reviewing the usefulness of the budgetary process. That is, the budget committee will look at the budget processes and identify the areas that are useful to us and making appropriate improvements. Please, let us try to read this. All right. We might need to stop tonight. Next week, we round up the class. Any question, please?
Well done, sir. Sir, please, can you please help me to differentiate, though you said it at the beginning of this class, I didn't hear you clearly, the difference between the flex and flexible budgets.
All right. I'm going to take the three together again. Your fixed budget. That is the original budget that is not expected to change. That is the original plan of the company. The fixed budget is prepared prior to the budget year. Like now, we are in October. Your fixed budget for next financial year, 2026, will be prepared in October and November. You now have the flexible budget, also prepared alongside the fixed budget. But the fixed budget, the flexible budget can accommodate changes in circumstances. Now, the flex budget will be prepared at the end of the financial year. Where you are giving the actual results. At the end of financial year, you know the budget. You prepare budgets prior to the year that you want to achieve this in 2026. You want to achieve, okay, like this budget we prepare now, flexible budget. We want to achieve 13,077 units in next financial year. That's our flexible budget. For this question we just solved, the plan of the company is that next financial year, the company will have a flexible budget at activity level, at capacity 13,077 units. At the end of next financial year, you are going to have actual results. Assuming the actual results, the company produced and sold 15,000 units. Aha! Look at it too. Under our flexible budget, our plan is to produce and sell 13,077 units. At the end of next year, we produce and sold 15,000 units. That means the level is not the same. The level of activity is not the same. You now require, examiner can now ask you, carry out variance analysis between flexible budget and actual results. Examiner can ask you, carry out variance analysis between flexible budget and actual results. You cannot carry out analysis here because the activity level is not the same. Look at this. This flexible budget is on 13,077. Actual result is on 15,000. That means you must prepare a third budget called flex budget. There must be a flex budget. This flex budget now, you are going to take it to 15. This flexible budget, you are not going to change it to 15,000 units. That means your revenue now, your revenue will change. Look at this, at 13,077. Our revenue value here. Okay, let me do something. Please, what is selling price here per unit? At 13,077, total revenue 5,000,011. Total revenue per one divided by 13,077.
452.
Price per one is like 452. The selling price here per one, 452. If you now want to do flex budget now, now come here and say, look at it here. This 15,000 units, you now do like this. 15,000 actual quantity sold multiplied by the budgeted selling price per unit, 452. You see it now? Because you have now removed this 13,000 actual quantity sold multiplied by the budgeted selling price per unit. That means the revenue will now be that has changed. 6 million. Revenue here 6 million 780 780. You are not going to take the actual result against budgeted revenue, budgeted selling price per unit, and budgeted cost per unit. We are still going, that is what we call variance analysis. When we get to next week now, that variance analysis you are doing, what you are doing is that you are flexing the budget. I hope it's better.
Thank you very much, sir.